So let's kind of look at investment strategies at this time. Well, I think you raised one good point that I agree with you, and we probably will get a lot of heat from this from some people, but you and I kind of feel indexing is the way to go for most people.
Yep.
Unless
Absolutely.
maybe you're a professional like us or something, but
Yep.
certainly regular indexing. I remember years ago, I wrote an article and it came out and I said that Wall Street would be overtaken by indexing and algo. And this was 1996 or 7, and I got laughed at and they said, no, never happened. And of course, today, 90% of the money is either indexed or algo. I mean, there's very few. And even some of the managers who claim they're active, they really do closet indexing, but they won't tell you that. So
Agreed.
Going forward, what do you think? Like, how should a person get set up? Should they, a young person go to a robo shop? What's the future of wealth management? What do you think is out there?
I think for a young person just starting to build a 401k, start to build a personal portfolio. And look, I got sons in my 20s, so I deal with this. I have one son who just lays back and puts money to his 401k and gets subsidized by his company. My other son likes to trade options. It's two different ways of looking at life. But in both cases, I just emphasize long-term allocations. Take advantage of the tax advantages you have in 401ks and IRAs. I certainly didn't do enough of that because I was a little bit more like my older son, who's the options trader when I was a kid. So, I've learned a few lessons as a result, which is why I try to tell him, don't take money out of your 401k, keep sticking money in there. But I think indexing makes a lot of sense longer term. The robos, the robos have been under a lot of pressure. You may recall, John, they blew up about 2 or 3 years ago when we had that sell-off. I think it was Q3 of 18 when China sold off. Some of them just stopped trading. Their systems
and even in the sharp sell-off, Robinhood couldn't stay open for a while. Yeah.
Yeah, and on that note, I'm not picking on Robinhood, but I'm glad you brought them up because my son who trades options trades through Robinhood, and I'm always at a loss to figure out how they're making money on free trades. They've got to be clipping it from someplace, or maybe their VCs are funding them. I don't know, but I've encouraged them to go to like the Schwabs and the Fidelities of the world, where you pay very little and you have a giant company behind you that has custody and all that good stuff. So I've been somewhat successful in getting them to do that. But I think for younger people, if you're 35 or less, this sell-off is an opportunity to maybe readjust your asset allocation to favor equity more than fixed income, to take advantage of the bounce back that John and I have been talking about for the last few minutes.
Yeah, I kind of on the same wavelength. I think if you're a younger person and you started to work and all that, I would have it deducted from your pay. Now, of course, that's not easy to do because people always come up with bills or make-believe or real bills. And I'm not saying some of the bills aren't real, but it's hard to do. But if it's taken out of your paycheck, there's less likelihood that you're going to start making exceptions this week.
Correct.
And you don't get used to the money. So that's at least a good way. And what I found out in some of my intern programs that I teach, some of the firms actually make you do that. You have to have a very good reason not to go into a K plan. You have to give the company a good reason. So that's kind of positive to do it like a certain deduction. So then the question is, how long can you stay with it? Because you have family, you have kids, you have a house, mortgage, and all that stuff. And, things get, so then, that's called like some sort of financial planning. Somewhere you have to say no to expenditures and yes to longer term kind of investment strategies. But I kind of agree with the index because there's no fees today.
Correct.
And what most people don't realize, if you pay 1.5% or 2% fee in 15 years, 1/3 of your money is gone just through fees, So
that's exactly correct. Yes. Yeah.
So you really need to have somebody who has a very good alpha to offset that. And we know from the evidence out there, 95% of the managers can't beat the index. And we've seen that in endowment funds, hedge funds, really traders, really it's hard to beat the market. Even though we think we're smart, sometimes the market tends to be smarter than we are. And I personally am surprised how quickly we came back off the bottom and how the NASDAQ is doing what it's doing, based upon what has happened. So that goes to show you, sometimes even professionals get faked out.
No, unquestionably. I mean, nobody predicted this. Everybody, a lot of people have said sooner or later the market's going to have an inevitable sell-off. Believe you me, I've been hearing that. I've been advocating that myself. I think the market the last 4 years has been a little bit out of control, to be honest with you. I've said that publicly. I didn't expect this to be the factor for the sell-off. Oh, and by the way, those of us who were saying that the market's going to correct, we were basically wrong for 10 years. So yes, it's here now, but to the point that you were making earlier and that the charts were making earlier, even this is not as bad as we thought it could be. So the market does have some underlying strength. And you're also 100% correct about the fact that if you're paying an active manager, and the average active equity manager nowadays charges 85 basis points. If you're not outperforming the index, you're just basically paying these people to underperform and to cost you money. So look, there are certain areas like high yield and emerging market equity where active management makes sense. But if you're a big proponent of large cap US equity, there is no alpha there. I've seen one manager in my entire career with alpha there.
So
they're essentially closed.
Let me go into another area that you and I either teach or involved in, and that's alternative investments.
Sure.
As we know, a lot of money went into alternative investments over the last 15 years. And I think today the average institution has 25% of their assets in alternative investments. And on the radar map, naturally, a lot of people have been disappointed with hedge funds. But
Absolutely.
there's an appeal for private equity.
Yep.
And so there's some academic research that questions whether there's an alpha in private equity. But with that said, it's still around. And then real estate has all kinds of different investments. So what's your feel on alternative investments? Would you put a high net worth person in there? And if so, what do you think is appealing?
Yeah, absolutely. I mean, I think you're extremely correct on hedge funds. And I've been over the course of my career, a big proponent of hedge funds. I've allocated to them personally and on behalf of clients for a long time now. I'm disappointed generally. Maybe first quarter of this year, we saw a little bit of a outperformance. Certain managers did do reasonably well, but that to me meant what that meant in practice was S&P's down 20, they're down 5. Is that a value? Yes, it's a value, but it's not like they went up while the S&P went down. Rare cases that did happen, but in most cases, yes, hedge funds outperformed. They were still down in absolute terms. Right now, and this is something you and I chatted about, if I'm really pounding the table on anything in hedge fund world, it's distressed. Distressed securities, and for those who aren't familiar with the term, these are investment managers, typically hedge funds with hedge fund pricing, who invest in the bonds of bankrupt or near bankrupt US and UK companies. The legal structures in the US and the UK favor lenders, far more so than in other countries. And they try to essentially buy busted bonds, bankrupt bonds at 5 cents on the dollar. They then have a seat at the table on a restructuring. And the idea is to buy the asset at 5 cents, sell off the remains of the company at 30 cents. Lehman Brothers was one of the great transactions.
You raised because it requires a high degree of knowledge.
Yep,
and you
absolutely.
can also become an equity holder and get good terms. So I think, again, it's for professionals, but that could be an opening for people who can diversify that risk.
Agreed. If you're large enough and can do it, or if you're an institution, I think it's time to do it. We have not had, the credit cycle has been so good for the last 10 years. The default rates some years have been 1.5%. That's obviously going to change a little bit. Neiman Marcus might be filing today. JCPenney might be filing today. Right. AMC Theaters, I think, filed last week. Look, the government's going to bridge us, as we talked about earlier, and a lot of people are going to have their livelihood saved, I think. But remember that the government is really trying to bias this help towards the average person and smaller businesses. I don't think they care if AMC goes out of business.
Shareholders in the process, so
yes.
And so you know, what I'm saying is that right now the U.S. government is the biggest private equity fund that's developing
Yeah,
because
yeah,
they can print all the money they want. They don't have to do any kind of roadshow, you know,
yeah, and that's
and they can
exactly
buy
what's
anybody
happening.
they want, right?
Yeah, yeah.
So the only
Um,
question is it going to be a good investment, you know?
yeah, so that's why I think distressed finally makes sense after 12 years.
Hmm.
And you mentioned private equity before. I'm still a proponent for larger clients, for venture capital. There's no evidence that technology is going to become less important in the future. And if anything, technology arguably saved the economy in the last few months and weeks, because think about, I think 40% of all Americans are working from home. I mean, we're working from home doing
Right,
this,
right.
right? If people couldn't work from home, that'd be more businesses shutting down, more people out of work. Here at least, and look, I don't love Zoom and FaceTime for everything. I think all of us have gotten a little tired of it at this point, but the reality is we're able to do something constructive like this because of advanced technology. You know, there's a
Right.
reason Zoom stock zoomed,
Yeah.
pun intended, while the market was selling off.
I mean, everybody I
So,
know is on Zoom.
right. Yeah. I mean, if I have one more
Yeah.
Zoom cocktail party, I'm going to, I don't know, toss myself in front of a train,
Well,
but
you know, the one thing I do like your idea of the venture capital, but the approach I would take, and this is my personal opinion, since now
sure.
I'm not an expert on all these biotechs and all that, I would just devote maybe to an IBB, which is the index fund for biotechs, or some
Hmm.
sort of index, because unless you have a top manager and you go into that VC fund through a private, you know, bank or something, you're not going to have, you're not that smart enough to know which technology and which drug is going to
Absolutely.
make it right. Yeah.
Absolutely, 100% agree. In fact, we have relationships with large family offices, and I'm always amazed at these people who are running, you know, billions on behalf of very intelligent families who made their money in heavy industry or something like that, allocating to biotech managers and software companies that they don't know anything about. I mean,
They don't,
you
yeah.
need software experts and
So you need a
biotech
lot of
experts to
companies to diversify that risk, it would appear.
absolutely,
Okay,
yes,
let's look at the
100%.
last area. How about real estate? Now, real estate, you can go everything from collecting rent, which is a quasi bond, all the way
Hmm.
to development, which is VC, you know. So there's all kinds of shades of black and white and gray in real estate. What do you think is the opportunistic area?
Look, I think real estate, like equities, got a little ahead of itself in the last few years. For those of you listening in, John and I live in, John's in New York City. I'm looking at New York City from northern New Jersey right now. Here in the New York metropolitan area, you know, when Ken Griffith spends $260 million on a penthouse on Central Park South, there's
That,
something wrong. There's something wrong. Okay, God bless Ken, but there's something wrong. So I think
God
real
bless
estate
Ken,
is,
is right.
God bless Ken. You know, it's wonderful. So I think real estate's getting corrected a little bit. Obviously, short term, you're going to have pressure from
Yeah.
multifamily apartments on people being able to pay the rent. Clearly, that's an issue short term. But look, I mean, things got out of control. This is not anybody's preferred way of correcting an overvalued market. But John, this is actually some stuff which I've learned about just in the last day or so since we last spoke. This is
Mhm.
like hard, real information. A couple real estate families that we work with, we were talking to them today and we were talking to them on Friday. So one of them was trying to sell a multifamily asset in Philadelphia, in an up and coming area of Philadelphia. They were offered 18 million last September, I think it was. They held off because they thought the market was going to continue to improve, come more to their preferred price, which was
Right.
22 million. New price today from the same persons that offered them 18 million in September, new price today 12. So that's
12.
interesting.
Yeah, yeah.
Another family that we work with in Palm Beach
Hmm.
was just before the COVID-19 situation hit, was looking at a building in just south of Palm Beach. I forget the name of the town, and the asking price was 96 million. New asking price 76 million, because the developer is under pressure and they have a bad balance sheet. And this
Yeah.
family, which has a lot of cash, may go in to take advantage of that. So I think you're seeing that correction. I don't know how long it's going to last though, because the one thing I've learned in the course of my career is people love real estate. Investors globally love real estate. and non-U.S. investors love U.S. real estate because of the dollar, and we're a stable country, et cetera, et cetera, et cetera.
Right.
So I think real estate is in for a very short-term correction, but those who have cash right now would be wise, I think, to be looking at that space. And the tax advantages, are insane. Yeah,
well, I would say even before Corona, we had the SALT effect in the Northeast.
Absolutely.
A lot of people are moving out to Austin, Memphis, Tampa. And now,
Florida.
Look at Zoom and all this technology. Some of this, you could be in other areas. And meanwhile, the local taxes in places like Westchester, Connecticut, whatever, and all that, they just keep going up, and something has to give. And some of those budgets are very unbalanced. So
New York State's what, $7 billion short now, or maybe more?
It's going to be a lot. Yeah. I think we're going to be, we're going to really need a bailout from the government. That's, reminds you of that headline. Remember Ford? When we were in 1974, we went to Washington for a bailout, and the headlines in the paper was Ford to New York City, drop dead. We're not going to give you a dime. And we had the Big Mac bonds, 10% triple tax free.
I remember those days.
Yeah, that was the big turnaround. Yeah. So I guess the other thing that kind of is interesting is, okay, now we're Zooming and all this, and some of this will go away and some will stay though, but do we need all this office space? That's the other question.
I think that's a very key point. Yeah. I think all of us right now, we're trying to find some long-term wisdom, what's going to happen next. And I think, John, you alluded in the opening to the new normal. I'm a little cynical about new normals because I remember during the 9/11 period, everybody said, oh, people will never want to live in high-rise New York City apartments ever again because, planes could go in them. And I'm looking at a 1,750-foot tall apartment building being built on Central Park South from my office. So it's, new normal, schnew normal, right?
Yeah.
But I think, and John, please comment on this, but I think crises like this accelerate trends that were already in place. So I think, I was mentioning earlier, I think like Amazon's, I'm not picking the stock, but Amazon is clearly going to be a big winner from this because some people who weren't ordering from Amazon before are now saying, hey, this is great. I order like Clorox and it comes to my door. I order socks.
Well, you know what I read?
This is awesome, right?
I read that, remember the old Lord & Taylor building? Lord & Taylor.
Which WeWork was taking over, I think.
I think Amazon,
like
isn't Amazon buying it for $1 billion? That whole...
I think so. Now, WeWork was supposed to move in there, but WeWork obviously ran some problems. So I think it might be Amazon's new New York
I thought I read,
headquarters or something like that.
Yeah, but it's amazing. Amazon is buying all this stuff in the city. Meanwhile, they got kicked out of Long Island City. But meanwhile, all this money is going into other areas of the city. And then there's Facebook doing it, So again, this goes back to my kind of sunrise stocks. They're still in the game. There's still a real estate demand there, warehouses or something. So I think investors may have to pick their spots in real estate. It may not just be a traditional, B building that you're going to rent up, but you're going to have to think beyond, what's the longer term potential based on a changing economy.
Yeah, and to your point of earlier, I think some people are going to say, I think employers are going to say, oh, wow, I don't need 50 desks in my office. I need 40. I can rotate some people. And employees are going to say, oh, wow, working from home, it's not as bad as I thought. I think that accelerates a long-term trend that's driven by technology. And as I was saying earlier, technology is not going away. So a lot of underlying trends are going to be accelerated. And one more, not to go too much on this, but I also kind of mentioned that AMC movie theaters may be filing for bankruptcy or did file bankruptcy last week. With being able to rent movies on really nice high-def screens, look, this is something that's already been going on. Why go to the movie theaters when it's $30 to go see
this
Avengers
is the thing,
or something?
With my wife, we watched Little Women. It's a great movie. But do I really need to be in the theater to watch that? I was perfectly comfortable watching it from my living room on my big screen, and if you have to pause and get a beer, okay, but you kind of at the point, but only certain movies maybe you want the big special effects, the 3D effects, but a lot of these movies you don't have to, It's not a black and white TV box anymore, obviously. So,
Correct.
okay, so I think we can kind of start wrapping up here. We got about 4 or 5 minutes from what I see on the clock. Any just general comments you want to make, Chris, before we kind of end here?
Yeah, I think the one thing I would say to folks trying to navigate through these difficult times, as I mentioned earlier, all of us on Wall Street, you know, I think we're fairly well versed on markets and economics, maybe politics to a lesser extent. Some of us know a lot about things like energy markets, but I'm very hard pressed to know too many people in our industry who are medical experts. It's yeah, they're biotech investors, sure, but that's a very small subset. There's a lot of noise in the marketplace right now. There's a lot of bad information, I think. You know, working from home, I keep CNBC on so I can track the markets, and occasionally I'll flip it on if Howard Marks is on or something like that. But there's just a lot of dreck out there. And look, I'm not putting down Mark Cuban. You know, Mark Cuban's a multi-billionaire and I'm not. But Mark Cuban does not have a lot of expertise in virology. You know, Dr. Fauci has it, Scott Gottlieb has it. So there's a lot of noise out there, and even the experts don't have a great deal of certainty. John and I talked earlier about the pandemic of 1918. There is something to be derived from that, and it's optimistic read too, if we're all lucky. But it is challenging markets to operate through right now. I would just not be panicking and going to cash and then watching the market go up 20, 30%, and then you get in at a much higher level, and then it sells off a little bit because it went up too quickly. I think maintaining a plan, maintaining a discipline makes sense. Certainly there's challenges out there, but selling at the bottom is never the route to success. Yeah. Selling at the top is great, but selling at the bottom usually leads to bad long-term outcomes.
So I kind of mirror some of the things you said. I would add, you know, again, I think the way to invest is a long-term approach. I think you start doing trading, timing, option gymnastics, you got to be a professional because you're going to end up losing most of your money that's the evidence out there. I say regular indexing, broadly diversified. So if you're a younger person, I think this is really, nothing because you have many years of investing and regular indexing, you're going to just keep buying at the bottom for a while. Now, the area that's going to be challenging is if you have gray hairs, you're close to retirement, and you really don't have anything in the pot. Well, that's a problem. The other problem is you have, but you've been relying on fixed income, and now you're going to say, gee, I got to get a substitute for fixed income to get that yield. And as we talked, it's going to be some sort of a high-risk product in drag, and you're not going to be aware of it. So I would say that the other thing, too, is it's hard to do some sort of a fundamental analysis to get that comfort. I think this is where you blend fundamentals, technicals, like you and I are doing, because the technicals are going to tell you more than the fundamentals. And we've seen that in all turning points where we think we know everything at the top and the bottom, and the technicals are saying you're not that smart, there's other things happening. So I think this time around, the technicals said, you know, there was a lot of panic selling at the bottom. People really, we saw super VIX, we saw high liquidations in the equity funds, and those things tend to happen at a bottom. So hopefully it's a bottom. Or the bottom for quite a while. But if anything, I think going forward, if you're middle-aged and so forth, younger person, and you're doing regular indexing, and God forbid you don't lose your job, but let's say you still have your job, I would not really lose a lot of sleep. And as we've seen from one of the charts, year to date, there's really not much damage if you're diversified, right?
Not in the broad market. Nope.
Now, if you have 100% in small caps and you're at retirement, well, that's a stupid strategy. You shouldn't be 100% small caps at retirement. 100%, if you're a young person, that's fine. Don't worry about it. Just keep buying more, you know. So in the end, I think this is not necessarily a challenging period. It's a challenging to take advantage of what's coming. So I put the sunrise stocks as kind of my area to go to. And again, that's my opinion. Not everybody's going to agree with me because they don't like, NASDAQ, they don't like Amazon and all that. But I don't think the area to go into are the banks. They're yesterday's industry. We have too many. They can be replaced through technology. We certainly don't need all these stores, all these shopping centers, these
And to
movies.
that point, we're going to have low interest rates for an indefinite period of time, which never helps the banks.
Right, yeah. So who knows how long these low interest rates will be around. And so, you know, everybody says, well, what about all the jobs lost? Well, you know, let's go back. When, you know, I was a kid, my mother was a file clerk. You had file clerks. Today, they're all replaced by computers. You don't have elevator operators. You don't have gas station attendants, except maybe in New Jersey, because by law, you have to have them. We're going to soon be, we're not going to have cashiers. That's going. Right now, a lot of stores don't even want to accept cash in New York City because of the coronavirus. You have to use a contactless or a credit card. So even with a credit card, you got to wipe it off, right? So I think going forward, the cashier is the next thing to go, you know.
Agreed.
And so little by little, the economy's changing. That's all I'm saying.
Yep.
Going from horseshoes to cars now to something else. And so I just think we should be a little bit more optimistic. And I think, you know, that as time goes on, we may look upon this as a good buying opportunity, which it was, in my opinion.
Agreed, 100%.
Okay. So I think with that, anything else, Chris? Is that it? Can we wrap it up?
I think we can. I just hope you continue to stay healthy and secure, and I hope everybody who is listening today,
you too.
Same to them.
Okay, and thanks again, Chris. And
Absolutely,
Candace,
John.
thank you again for the opportunity.
Thank you, Candace.
Thank you, gentlemen.